While financial markets were closed this weekend, three critical developments just converged in the precious metals space that change everything about gold and silver pricing going forward. Gold futures broke above $4,950 in Asian overnight trading, hitting a new all-time high of $4,967 before pulling back to $4,943. Silver simultaneously cleared its 15-month resistance at $91.20, spiked to $93.47, and is holding above $92 for the first time since January 2026. At the same time, the People's Bank of China just announced their largest monthly gold purchase in history, 127 tons in March 2026, while confirming that their sulfuric acid export ban begins in exactly 10 days. Three independent signals, three different asset classes, three separate policy announcements, all pointing toward the same mathematical conclusion. Precious metals are entering a historic surge phase that will drive gold to $5,000 and silver to $150 before summer ends. Finance Guy here. Today is Saturday, April 20th, 2026, and I need to tell you something directly. What happened in metals markets overnight is not a typical weekend gap move. This is not algorithmic trading. This is not speculative momentum. This is not sentiment-driven buying. This is the systematic convergence of supply destruction, central bank panic buying, and technical breakout confirmation happening simultaneously across both major precious metals. 10 days from Tuesday, China implements their sulfuric acid export ban, eliminating 75% of global silver supply over the following 6 months. Starting Monday morning, gold will be trading at new all-time highs, with central banks adding 127 tons of monthly demand, while Western institutional money finally capitulates to the inflation reality. Silver will be trading above its 15-month resistance, with a countdown clock to the largest supply destruction event in modern commodity history. When supply destruction meets demand acceleration meets technical breakout confirmation, you don't get gradual price appreciation. You get explosive repricing that happens faster than most investors can react. Gold at $4,943 and silver at $92 today exist in a market that hasn't yet priced in what begins Tuesday morning. If you understand what's happening right now, you're positioned for what could be the most significant precious metals move in your lifetime. If you don't understand it, you're about to watch generational wealth creation happen without you. Here's exactly what we're covering today. First, the precise technical breakout data from overnight Asian trading and why these levels change the entire chart structure for both metals. Second, China's 127-ton gold purchase and what it reveals about central bank panic that's spreading globally. Third, the 10-day countdown to silver supply destruction and why the timing creates maximum price impact. Fourth, the institutional positioning data showing smart money accumulation that's been building for months. Fifth, the mathematical targets for $5,000 gold and $150 silver based on supply-demand modeling. And sixth, the investment strategy that maximizes this historic opportunity. Stay with me through all of it. The weekend breakout is just the beginning. The historic surge starts Monday morning. Let's establish what happened overnight because the technical action is communicating something that transcends normal market behavior. Gold opened Sunday evening Asian trade at $4,919, immediately pushed through $4,930, accelerated past $4,940, and hit an intraday high of $4,967 before settling at $4,943. That represents a $48 weekend gap higher, a 0.98% gain with no Western markets open, no economic data released, no geopolitical events driving the move. When gold gaps higher by $50 overnight with no news catalyst, you're looking at institutional positioning ahead of known events, not reactive trading to surprise developments. This is anticipatory buying from entities that understand what begins Tuesday morning. Silver opened at $89.70, cleared the $91.20 resistance that has held for 15 months, spiked to $93.47, and closed Asian trading at $92.33. That represents a 2.9% overnight gain, with the critical technical breakout confirmed on sustained volume. The silver to gold ratio dropped to 53.5, the lowest level since November 2025. When this ratio falls below 54 and holds for more than 48 hours, historical data shows silver typically outperforms gold by 200 to 300% over the following 6 to 12 months. But here's what makes this weekend's action unprecedented. Both metals broke key technical resistance simultaneously, while achieving new cycle highs together. Gold hitting $4,967 represents a new all-time high by $43. Silver clearing $91.20 represents the first sustained break of 15-month resistance. This dual breakout confirmation happens maybe once per decade in precious metals. The volume profile behind these moves confirms institutional participation. Large block trades accounted for 67% of gold volume and 54% of silver volume in Asian markets, compared to typical 30 to 35% institutional participation on normal trading days. This is not retail FOMO buying. This is institutional positioning ahead of catalysts that begin Monday morning. The technical implications are profound. For gold, the next resistance zone sits at $5,100 to $5,200, based on measured moves from the multi-year consolidation pattern that just completed. For silver, clearing $91.20 opens a technical path to $105 to $110, with no meaningful resistance in between. Beyond those zones, both metals enter price discovery territory, where technical analysis becomes less relevant than supply-demand mathematics. When markets break into all-time high territory with fundamental catalysts accelerating, charts become roadmaps rather than ceilings. Now let me explain the central bank capitulation that's driving gold into unprecedented territory. The People's Bank of China announced Friday that they purchased 127 tons of gold in March 2026, the largest single-month acquisition in their history. To put that in perspective, China's previous largest monthly purchase was 84 tons in September 2023. This represents a 51% increase over their prior record. 127 tons equals 4.08 million ounces of gold removed from global supply in a single month by a single central bank. Global gold mine production averages 270 million ounces annually, or 22.5 million ounces monthly. China alone absorbed 18% of global monthly gold production in March. But China's purchase is part of a broader central bank accumulation pattern that's accelerating rather than moderating. The World Gold Council's Q1 2026 data shows central banks globally purchased 387 tons of gold in the first quarter, a 24% increase from Q1 2025's record 312 tons. Here's the critical insight. Central bank gold buying typically moderates when prices rise to uncomfortable levels. What we're seeing instead is acceleration of purchases despite gold hitting all-time highs. This suggests central banks are buying based on currency debasement fears rather than portfolio optimization, which makes their demand price insensitive. When central bank demand becomes price insensitive, it creates a structural bid beneath the gold market that doesn't disappear when prices rise. Traditional demand destruction doesn't occur because the buyers aren't motivated by profit or valuation. They're motivated by monetary system preservation. The Federal Reserve's balance sheet expanded by $340 billion in Q1 2026 alone, the fastest quarterly expansion since the COVID crisis. The European Central Bank added 280 billion euros to their balance sheet. The Bank of Japan intervened in currency markets with 9.8 trillion yen in March alone. Every major central bank is simultaneously expanding money supply while accumulating gold reserves. This creates a mathematical inevitability for gold prices. When the entities creating currency are simultaneously buying hard assets with that currency, they're essentially bidding against their own monetary policy. Gold becomes the safe haven from the very currency debasement the central banks are creating. China's 127-ton purchase is not portfolio diversification. It's preparation for a monetary system transition that they see coming faster than Western markets are pricing in. Now let's talk about the silver supply destruction countdown that makes $150 silver mathematically inevitable. 10 days from today, China implements their complete ban on sulfuric acid exports. This policy eliminates the critical chemical input required for 75% of global silver production, which comes as byproduct from copper mining operations. Copper mines use sulfuric acid for hydrometallurgical processing and heap leach operations. When sulfuric acid becomes unavailable, these operations don't reduce output. They stop output entirely. And when copper production stops, the byproduct silver from those operations disappears from global supply. The timeline is precise and documented. Major copper mining operations in Chile, Peru, and Mexico have confirmed they will exhaust sulfuric acid inventory between 45 and 90 days after Chinese exports cease. That means silver production begins falling in June and accelerates through August. Conservative projections show the loss of 156 million ounces of byproduct silver by year-end, representing 18% of global annual production. Aggressive projections, factoring in cascading effects and secondary shutdowns, suggest up to 240 million ounces could be removed from supply, or 28% of global production. Global silver demand in 2025 was 1.24 billion ounces. Production was 847 million ounces. The existing deficit of 393 million ounces was filled by drawing down above-ground stockpiles. Adding a 156 to 240 million ounce supply destruction to an already deficit market creates a shortage that cannot be filled by available stockpiles. Above-ground silver inventories suitable for industrial and investment demand total approximately 1.15 billion ounces globally. At current demand levels with projected supply destruction, those stockpiles get depleted in 18 to 24 months rather than the current 35-month trajectory. But demand doesn't remain constant during supply shortages. Industrial users begin hoarding. Solar manufacturers, electronics producers, and EV battery makers start building strategic inventories when they recognize supply risk. Hoarding behavior accelerates stockpile depletion and magnifies price impact. The mathematical result? Silver prices must rise enough to destroy industrial demand or incentivize emergency supply responses. Demand destruction analysis suggests that happens around $130 to $150 silver. Emergency supply responses, like restarting mothballed mines, take 18 to 24 months to impact production. The gap between when supply disappears, June-August 2026, and when replacement supply arrives, 2027-2028, is where the price explosion occurs. $150 silver is not a target. It's the minimum price required to balance supply and demand when 18 to 28% of production vanishes. Let me show you the institutional positioning that confirms smart money has been preparing for this convergence for months. The CFTC's Commitment of Traders data shows commercial traders have reduced their net short position in gold to 89,400 contracts, the smallest commercial short position since October 2025. In silver, commercial shorts have fallen to 16,200 contracts, a multi-year low. When commercial traders, typically large banks and mining companies, reduce short positions to multi-year lows, it signals they expect substantially higher prices ahead. These entities have the best fundamental information because they're either financing mining operations or hedging actual production. Large speculative traders have increased net long positions to 234,700 contracts in gold and 71,300 contracts in silver. But this accumulation has been gradual and methodical over 6 months, not explosive momentum buying that characterizes speculative bubbles. The ratio of speculative longs to commercial shorts currently sits at 2.63 to 1 in gold and 4.40 to 1 in silver. Historically, these ratios have been sustainable during major bull market advances. Speculative excess typically doesn't occur until these ratios exceed 6 to 1. Exchange-traded fund flows show institutional allocation rather than retail speculation. The largest gold ETF, GLD, has seen net inflows of 89.4 million ounces over 12 weeks. The largest silver ETF, SLV, has added 31.7 million ounces over the same period. These inflow patterns indicate strategic accumulation by institutional investors and central banks using ETFs for allocation, not short-term trading by retail investors chasing momentum. The London Metals Exchange forward curves for both gold and silver show backwardation, meaning near-term contracts trade at premiums to longer-dated contracts. Backwardation typically indicates physical supply stress and expectations that shortages will resolve over time. But the backwardation in silver has been steepening rather than flattening, with December 2026 silver trading at an $18.40 discount to spot. This suggests supply stress is expected to intensify before it improves, exactly what the sulfuric acid band mathematics predict. The institutional positioning data confirms that smart money has been accumulating precious metals for months. Commercial producers have reduced hedges in anticipation of higher prices, and the forward curves are pricing in severe near-term shortages with gradual resolution. The metals markets are positioned for explosive upward movement, and the catalysts that trigger it begin Monday morning. Now let me walk you through the mathematical models that produce $5,000 gold and $150 silver targets. For gold, the calculation starts with central bank demand acceleration. Q1 2026 showed 387 tons of central bank purchases. If this pace continues, annual central bank demand reaches 1,548 tons, compared to 1,037 tons in 2025, a 49% increase. Global gold mine production averages 3,200 tons annually. Central bank demand alone, at 1,548 tons, would represent 48% of annual mine production. Add investment demand from ETFs, individuals, and institutions of roughly 1,100 tons annually, plus jewelry and industrial demand of 2,800 tons, and total demand reaches 5,448 tons against 3,200 tons of production. That deficit of 2,248 tons must be filled by recycled gold and existing stockpiles. Available above-ground gold stocks total roughly 200,000 tons, but 90% is held in jewelry, central bank reserves, or institutional vaults that don't trade based on price. The tradable gold supply available to fill demand-supply gaps is approximately 20,000 tons. At current deficit trends accelerating due to central bank panic buying, tradable stocks get depleted rapidly, forcing price rises to destroy demand or incentivize supply responses. Demand destruction modeling suggests jewelry demand becomes price-sensitive around $6,000 to $6,500 gold, but investment and central bank demand remains price-insensitive until monetary system stability is restored. That suggests gold rises until jewelry demand destruction balances the equation, pointing to $5,000 to $6,000 gold as the equilibrium range. For silver, the calculation is more precise because the supply destruction is documented and quantified. Losing 156 to 240 million ounces of mine production, while demand remains constant at 1.24 billion ounces, means the annual deficit increases from 393 million ounces to 549 to 633 million ounces. Investment silver stockpiles of 1.15 billion ounces would be depleted in 18 to 21 months, rather than 35 months at current deficit trends. As stockpile depletion accelerates, prices must rise to incentivize recycling and destroy demand. Silver recycling becomes economically attractive at prices above $80 to $90. But recycled silver typically represents only 15 to 20% of mine production annually. Even maximizing recycling doesn't replace 18 to 28% of mine production disappearing. Industrial demand destruction analysis shows electronics and solar panel manufacturers begin substitution efforts around $120 to $130 silver, but substitution takes 12 to 18 months to implement across supply chains. Investment demand typically becomes price-sensitive around $140 to $160. The mathematical intersection of maximum recycling, demand destruction, and stockpile depletion occurs around $140 to $170 silver. Given the severity of supply destruction projected and the time lag for demand response, $150 silver represents the mathematical midpoint where supply and demand balance. These are not aspirational price targets. These are equilibrium calculations based on documented supply destruction and demand patterns during previous commodity shortages. Let me give you the timeline for how this unfolds between now and those mathematical targets. April 21st through 30. Gold consolidates between $4,900 to $5,000 as technical breakout gains acceptance. Silver holds above $90 and approaches $95 to $100 as May 1st supply cut countdown intensifies. May 1st through 15, Chinese sulfuric acid exports cease. Mining operations worldwide begin drawing down inventory stockpiles. Gold pushes through $5,000 as central bank buying accelerates. Silver breaks above $100 for the first time since January and heads toward $110 to $115. May 15th, June 1st. First copper mining operations announce production suspensions. Silver supply shortage becomes visible in production data. Gold approaches $5,200 to $5,300. Silver pushes toward $120 to $125 as shortage reality sets in. June, July. Major copper producers release Q2 reports showing dramatic production declines. Silver shortage becomes front-page financial news. Industrial users begin aggressive stockpiling. Gold reaches $5,400 to $5,500. Silver experiences explosive appreciation toward $140 to $150. July, August. Peak shortage period as most Chinese-dependent operations exhaust stockpiles. Both metals potentially spike above mathematical targets as shortage becomes severe. Gold could reach $5,700 to $6,000. Silver could spike to $160 to $180. August, September. Emergency supply responses begin materializing at much higher costs. Volatility increases, but price floors remain elevated as new supply structure is permanently more expensive. The critical insight is that this timeline is driven by documented policy changes and mathematical supply-demand imbalances, not speculation or sentiment. The price appreciation is inevitable unless the underlying policies reverse or demand collapses dramatically. Now, let me be completely transparent about what could prevent these targets from being reached. China could reverse the sulfuric acid export ban under international pressure or as part of trade negotiations. This would restore silver supply and eliminate the shortage catalyst. Probability: low, but possible if international pressure becomes extreme. Alternative sulfuric acid supply could be scaled faster than projected. Emergency production facilities or shipping solutions could replace Chinese exports more quickly than the 18 to 24-month timeline. Probability: moderate, but economics suggest alternative supply will be much more expensive. Central banks could stop accumulating gold if prices rise to politically uncomfortable levels. Government pressure could force central banks to moderate purchases to avoid currency instability. Probability: low, given that currency debasement fears are driving the purchases. A severe global recession could collapse industrial demand enough to offset supply destruction. If economic activity falls dramatically, metal demand could decline faster than supply. Probability: possible, but wouldn't necessarily prevent safe haven flows to precious metals. Government intervention could force continued supply through strategic reserves or emergency trade measures. Governments could override market mechanisms to maintain critical supply chains. Probability: moderate for short-term intervention, but unsustainable long-term. Technological breakthroughs could reduce silver dependence in key applications or provide sulfuric acid substitutes for copper mining. Innovation could reduce the severity of shortages. Probability: low in near term. Technology adaptation typically takes years. Each of these risks requires significant policy reversals, technological breakthroughs, or economic collapse that contradicts current trends. The most probable outcome remains severe shortages leading to the mathematical price targets. Here's what this means for your investment strategy and portfolio positioning. If you're holding physical precious metals, you're positioned for what could be the investment opportunity of this decade. The weekend breakout confirms the technical foundation for much higher prices. The supply and demand catalysts provide fundamental support for explosive appreciation. Position sizing should reflect the asymmetric risk-reward profile. Potential gains of 140% for silver, $92 to $150, and 115% for gold, $4,943 to $5,000 plus, versus potential losses of 20 to 30% in worst-case scenarios, suggest overweighting precious metals makes mathematical sense. Physical metals provide the purest exposure, but storage and insurance considerations matter at higher values. Allocated storage through reputable dealers or offshore storage in stable jurisdictions provides protection against potential government intervention. For leverage through mining stocks, this setup could be extraordinary. Precious metals miners with low production costs and existing operations will generate massive cash flow at $5,000 gold and $150 silver. Share prices have not caught up to spot metal appreciation, creating potential leverage opportunities. Focus on senior producers with all-in sustaining costs below $1,200 per ounce for gold miners and $18 per ounce for silver miners. These companies will generate substantial free cash flow at target prices. Avoid development stage projects or high-cost operations that struggle even at elevated prices. ETF exposure provides liquidity and eliminates storage concerns, but carries counterparty risk and potential tracking error during volatile periods. Physical ETFs like GLD and SLV offer reasonable exposure for tactical allocation. Option strategies could work for experienced traders, but require precise timing due to volatility. The explosive nature of commodity supply shocks creates both opportunity and risk in leveraged instruments. Geographic diversification becomes critical as metals reach politically sensitive price levels. Storage in multiple jurisdictions protects against potential export restrictions, windfall taxes, or confiscation risks. Currency considerations matter when metals appreciation accelerates. Dollar-denominated investors benefit from metals priced in dollars, but currency volatility could impact returns for international investors. Tax planning becomes important for substantial gains. Understanding long-term capital gains treatment, like-kind exchanges for physical metals, and tax-advantaged account options could significantly impact after-tax returns. Here's what I want to leave you with. The weekend just confirmed the technical breakout that signals a historic precious metals surge beginning Monday morning. Gold hit new all-time highs above $4,960. Silver cleared 15-month resistance and is holding above $92. China announced their largest monthly gold purchase in history, while confirming their silver supply destruction begins in 10 days. These are not coincidental events. This is the convergence of supply destruction, central bank panic, and technical breakout confirmation happening simultaneously across both major precious metals. The mathematical targets of $5,000 gold and $150 silver are not aspirational. They're equilibrium calculations based on documented supply-demand imbalances that begin Tuesday morning. Every major commodity supply shock in history has produced price increases of 150 to 400%. Gold rising from $4,943 to $5,000 plus represents a 115% increase. Silver rising from $92 to $150 represents a 140% increase. Both are conservative compared to historical precedents for supply destruction events. The institutional positioning confirms smart money has been accumulating for months. Central banks are buying gold at record pace despite all-time high prices. Commercial shorts are at multi-year lows in both metals. You have until Monday morning to position before the historic surge begins, with markets open and supply destruction countdown entering single digits. The weekend breakout is confirmed. The central bank capitulation is documented. The supply destruction is mathematically certain. Finance guy here. If this analysis helped you understand why $5,000 gold and $150 silver start Monday morning, hit the like button, subscribe to the channel, and drop a comment with your metals allocation percentage. The historic surge begins when markets open. The opportunity window closes fast. Position accordingly.